Right now, cryptocurrency charts are flashing bright green, and a wave of aggressive, rapid price action is sweeping across the market. Scroll through financial social media, and you will hear the exact same chorus. The long winter is finally over, and the next massive bull run has officially begun. That absolute certainty is being driven by one specific catalyst. Bitcoin recently pushed back up to a local high of $64,000 to $65,000, pouring gasoline on an already raging fire of investor FOMO. But when prices spike that quickly, the emotional pendulum swings hard. It becomes incredibly easy for retail investors to look at those climbing numbers and confuse a temporary aggressive price pump with a permanent structural shift in the market. Zooming out reveals a very different picture. One foundational metric has tracked this asset's price action since its inception 16 years ago. And there is a cardinal rule when dealing with this specific indicator. As a supposed bear market nears its end, you never, ever ignore what it is telling you. Right now, beneath all the celebratory posts and green daily candles, that 16-year-old metric is flashing a massive warning sign, throwing the entire validity of this current rally into question. To see what is actually happening, we must step away from the chaotic minute-by-minute trading view. We need to look at the macro timeframe, focusing exclusively on stable, long-term monthly candles. This historical upward-sloping support line has acted as the ultimate safety net for over a decade. In 2019, 2020, and 2022, the price dropped, touched this line, and bounced safely upward. When an asset bounces perfectly off the same floor cycle after cycle, investors begin to view that floor as completely unbreakable. That flawless track record bred a deep sense of invincibility, setting a dangerous trap for the current market. Because recently, the structure failed. For the very first time in history, the price decisively broke and closed below this decade-spanning macro support line. Now, this doesn't mean the asset is going to zero tomorrow. The sky isn't falling entirely, and panic selling isn't the answer. What it does mean is that we are primed for a classic false rally. That is, a scenario where the price pumps hard for a few weeks, giving the illusion of a full recovery, right before rolling over and crashing to even lower depths. Even if you are incredibly bullish on this asset's long-term future, you cannot afford to look away from this negative data point. Acknowledging it is mandatory for financial survival in this cycle. A broken historical support line completely reconfigures the risk profile. Buying in right now under these conditions stops being a calculated investment and becomes a raw gamble driven entirely by hope rather than data. Based on the macro timeline, a legitimate and stable end to this bear market is far more likely to arrive later in Q3, somewhere around September or October. To invalidate the current bearish warning before then, the market has to prove itself, and it does that by crossing a strict mathematical threshold into higher resistance. Looking at this chart, you can clearly see the gap. We are currently sitting in a volatile risk zone around 64 to 65,000. To mathematically confirm a true bull market, the price needs to cleanly break 72,000 and ideally push up into that solid $75,000 to $78,000 validation zone. Professional strategists don't try to catch falling knives or guess the absolute bottom. They preserve their capital and wait for the market to definitively validate its upward trajectory. Keep in mind, the ultimate macro target for this asset cycle remains a massive 6-digit valuation. If the final destination is well over $100,000, the slice of profit you miss between a $65,000 entry and a safer $75,000 entry is mathematically negligible. It is virtually nothing compared to the massive financial risk of buying the top of a false rally. The most logical move right now is to detach your emotions from the daily price action, tune out the noise on social media, and hold your position steady. Real financial security doesn't come from blindly chasing every green candle you see. It comes from keeping your capital anchored, staying patient, and letting the historical data tell you exactly when the danger has finally passed.